Welcome to vTalkInsight, Market Drivers Daily for March 12, 2026. Oil is back at the center of the macro story today, as the effective closure of the Strait of Hormuz turns a geopolitical flashpoint into a full-scale supply shock. Brent has pushed above $100 while record emergency reserve releases are barely containing the move, forcing a rethink of inflation, growth, and risk premia across assets. Let us start with how this evolving energy conflict is reshaping cross-asset pricing. The energy story has clearly escalated compared with recent days, moving from a scare to a full-blown supply shock. Disruptions around the Strait of Hormuz are now estimated to be removing roughly 8 million barrels a day from global supply, with tanker traffic running at barely 60% of normal levels. Brent has traded above $100 and has rallied for 9 straight sessions, while futures further out the curve have repriced higher, signaling expectations that tightness could persist rather than fade quickly. Coordinated releases of about 400 million barrels from strategic reserves are underway or planned, but that only covers around 20 days of normal Hormuz flows, and markets appear unconvinced that these barrels can fully offset the shock. On the ground, the Iran conflict remains the core driver of this risk premium. Recent military action has sharply reduced missile and drone launch capacity, yet Iran's leadership is signaling an intention to keep the strait effectively closed, and the country still holds one of the region's largest naval mine inventories. Efforts to organize secure shipping convoys with United States and allied escorts are progressing slowly, hampered by ongoing attacks and mine threats. So a rapid normalization of flows is far from guaranteed. The International Energy Agency now describes this as the largest oil market disruption on record, and even significant releases from United States reserves, already totaling more than 170 million barrels, have not pulled prices decisively lower. The macro consequences are increasingly visible in inflation and growth projections, particularly for Europe. Scenarios where Brent remains above $110 imply that European and United Kingdom growth could be cut by around half a percentage point, while headline inflation might rise by roughly 1 percentage point and stay above 3% for the year. For the global economy, several estimates now suggest persistent oil prices in the $100 to $120 range could shave 0.5% from growth and add up to 1% to inflation, reviving stagflation concerns that had faded earlier this year. Those pressures are already feeding through to consumers, with United States gasoline at the highest level since mid-2024 and airlines hiking long-haul ticket prices by close to 10% as jet fuel costs jump. Cross-asset pricing reflects this energy shock, but not evenly. Energy and gold-related equities continue to outperform, and fertilizer producers have rallied as nitrogen prices spike on fears around Middle Eastern and Turkish supply routes. By contrast, European banks and consumer staples are under pressure as higher yields, funding costs, and squeezed real incomes hit sentiment, and broad financials have slipped into correction territory. Bond markets are repricing as well. German 10-year yields have climbed more than 30 basis points since the conflict intensified, and long-dated government yields globally are rising on a mix of larger fiscal deficits and oil-driven inflation worries. Central banks, especially in Europe, are now viewed as more likely to delay cuts or even consider additional hikes, while United States policymakers signal a preference to wait and watch rather than react prematurely. There is, however, a credible counter-narrative that frames this as a severe but ultimately manageable shock. Adjusted for inflation, today's oil prices remain below peak seen during the 2008 crisis or the early stages of the Russia-Ukraine conflict, and European natural gas has not returned to its 2022 extremes, reflecting improved resilience. Non-Middle Eastern exporters such as Russia, Canada, Norway, and Argentina's Vaca Muerta field stand to benefit from higher prices and may ramp supply, while history shows that equity markets often regain lost ground within weeks once geopolitical fears begin to fade. Forecasts point to a wide range of outcomes. If shipping through Hormuz normalizes within a month, oil could slide back towards $70 to $80, easing both inflation and growth risks, whereas a multi-month closure could see prices reach the $130 to $160 range and push several major economies close to recession. Key watch points now are tanker and insurance conditions in the Gulf, any concrete progress on secure convoys, the speed at which reserve barrels actually reach refineries, and upcoming inflation prints that will capture the latest fuel spike. These energy and geopolitics dynamics form the macro backdrop for everything else, including the next major theme: how the AI build-out and digital infrastructure story is evolving within this higher-cost environment. Against that turbulent macro background, AI remains one of the few clear growth narratives, but it is increasingly framed as strategic infrastructure rather than just a technology trend. United States government AI projects are accelerating markedly, with supercomputing build timelines compressing from a decade to roughly 2 years, as agencies lean on commercial, open, and scalable architectures to speed up scientific research. Policymakers now describe AI infrastructure as essential for both national security and energy security, aiming to double research and development productivity and support a broader wave of reindustrialization. That in turn is sharpening focus on securing abundant, affordable power for data centers, reviving interest in nuclear and even longer-dated fusion concepts as part of the wider energy mix needed to sustain AI growth. On the enterprise side, adoption is broadening but remains early and highly competitive. Open weight models, which companies can host and fine-tune themselves, are gaining traction as firms prioritize data control and flexibility over a single proprietary provider. Platforms that orchestrate multiple specialist models, such as those offering secure server-side execution and sandbox data access, are seeing demand from corporates that want best-in-class performance without vendor lock-in. Anthropic is a notable share gainer, with paying adoption among businesses rising sharply over the past year, and its Claude models reportedly preferred in a large majority of direct enterprise matchups, even at higher price points. Yet more than half of firms on some platforms still have not begun paying for AI, leaving a sizable runway for future monetization and suggesting that we are still in the early innings of the enterprise cycle. Security and regulation are fast becoming the defining constraints on that growth path. The Pentagon's recent clash with Anthropic over usage restrictions and its broader effort to standardize terms across major model providers underscore the tension between innovation, operational control, and national security. At the same time, cyber threats are evolving. Attacks targeting AI and so-called agentic systems have surged since the Iran conflict began, with a meaningful share of enterprise incidents now focused on this relatively unprotected layer. Firms are starting to deploy AI-powered defenses, including automated red and blue teaming, but the attack surface is growing faster than protection in many organizations. Legal and trade risks add another layer, from disputes over data access between large technology and AI firms to new Section 301 investigations that could alter cross-border technology supply chains. In public markets, this uncertainty is contributing to a two-speed software landscape, where hyperscalers and some infrastructure names are supported by AI-driven revenues, while other software and IPO candidates face compressed valuation multiples and heightened scrutiny of their AI strategies. Beneath the headlines, AI is also starting to manifest in the physical economy. Industrial humanoid robots are moving from prototypes toward commercial deployment, with production targets in the high hundreds to low thousands of units by 2027, driven by labor shortages and the need for more flexible automation in factories and warehouses. Companies across automotive, logistics, and warehousing are already planning integration roadmaps, and geopolitical considerations are influencing where those robots are sourced and deployed as Western buyers scrutinize Chinese components and lean toward regionalized supply chains. Specialized AI infrastructure is another emerging theme, illustrated by large funding rounds for startups focused on mathematical and code verification, which aim to make complex software more reliable and compliant. For markets, The key questions now are how quickly enterprise spending on AI infrastructure and security scales relative to broader IT budgets, whether regulatory frictions slow the trajectory, and how far AI-driven disruption extends into sectors like software, which also feature prominently in private credit portfolios that are starting to feel stress. The private credit story has shifted from quiet growth to visible stress, particularly in United States retail-oriented vehicles, even as European platforms look more stable. Multiple flagship funds run by managers such as Morgan Stanley, BlackRock, Cliffwater, and others have hit redemption limits, with some imposing 5% quarterly gates after a surge in withdrawal requests. Several products have seen double-digit redemption queues build, and share prices in listed vehicles exposed to private credit have underperformed, echoing concerns that recall pre-financial crisis debates about hard-to-verify asset marks. In contrast, European evergreen funds dominated by institutional and bank balance sheet capital have so far avoided similar withdrawal pressure. In private credit, there is still viewed as a growth segment, helped by less crowded markets and more conservative underwriting. The core vulnerability is structural. Liquidity mismatches between investors and underlying loans. Semi-liquid funds offer periodic liquidity to retail and wealth clients, but the loans they hold can take months to refinance or sell. So when redemptions spike, managers are forced to gate, sell assets, or borrow. Concerns about opaque valuations, especially for loans to software firms facing potential AI disruption, are intensifying and risk creating a feedback loop where fear of gates and stale marks drives more redemption requests. Banks are also becoming more cautious, with institutions such as J.P. Morgan reportedly revaluing collateral and tightening funding lines, which challenges growth models that depend heavily on bank leverage. In response, some large managers like Apollo are moving toward monthly and eventually daily asset valuations to improve transparency and reassure investors, steps that could become a new industry standard if adopted more broadly. The key debate is whether this stress is an isolated liquidity episode or the early stage of a broader credit event. On the reassuring side, private credit defaults remain within historical norms, and there is little evidence so far of a solvency crisis in the asset class. Major banks have limited direct exposure, having to risk their balance sheets since the last crisis, and investment-grade bond markets remain robust, with record-sized deals pricing at tight spreads and no obvious contagion from private to public credit. Some analysts argue that much of the current selling reflects private market liquidity needs rather than a signal about the underlying economy, and note that the overall private credit market, at around $1.8 trillion, is still small relative to the core banking system. At the same time, critics warn that the long-running credit cycle and rapid growth of private lending raise the risk of mispriced assets, and that retail investors may have underestimated how long capital can be locked up once redemption gates are in place. The macro backdrop makes this more than a niche story. Higher for longer policy rates, driven in part by energy-induced inflation, raise interest burdens for leveraged borrowers and could expose weak credits if oil stays above $100 and growth slows. Stress in private funds is already nudging more companies back toward public bond issuance, which may increase supply and eventually test investor appetite if spreads remain tight. If concerns about valuations and liquidity intensify, flows could rotate toward government bonds as a perceived safe haven, reinforcing the re-steepening we are seeing in parts of the yield curve. Key indicators to watch now are the pace and duration of redemption gates. Any acceleration in default or restructuring activity inside private portfolios, shifts in bank lending terms to private credit managers, and signs that rating agencies or regulators are turning more vocal. How these pressures evolve, alongside the oil shock and the AI investment cycle, will go a long way toward determining whether current market volatility remains contained or broadens into a more systemic risk repricing. To wrap up, the effective closure of the Strait of Hormuz has turned energy into the dominant macro driver, pushing Brent above $100 and reviving stagflation risk, just as central banks were preparing to ease. At the same time, AI continues to attract capital as strategic infrastructure and a national security priority, even as security, regulatory, and competitive challenges create clear winners and losers across the tech stack. In credit, rising redemption gates and tighter bank funding show that private markets are not immune to this environment, though stress remains concentrated in specific vehicles rather than the core banking system. Taken together, these forces suggest that cross-asset dispersion, liquidity conditions, and policy reactions will be critical watch points over the coming weeks, especially if oil prices stay elevated. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.